We have 3 days packed with trading education today, with today, tomorrow, and of course on Thursday. And today we're going to kick it off with stocks and options, and we're going to go ahead with futures on Thursday and with Forex on Tuesday. And we are very happy to introduce Adrian and Julie Manz. I've met Julie at the Traders Expo this year in early January, I believe. And
yep, absolutely.
Pre-COVID.
before, as my friend said, before the world ended, which it hasn't.
Exactly.
It's all good.
Exactly. So I'm very happy to see that you guys are here and we could kick it off.
Yeah, thanks for having us. This is new to us. We're not we're usually found on the live circuit, and it's taking a little getting used to with the online stuff, but it's fun.
Mm-hmm.
All right. So are we ready to start?
Yeah, we're ready to start. So
I have started my recording as well, David. Yeah.
Okay, great.
All right, folks. So as you just heard, we are. I'm Adrian Manz, and I'm here with my wife, Julie Manz. Usually, you guys find us live at all sorts of events, talking about trading and what it is that we do. This is interesting for us because we are both psychologists who happen to also be traders. Excuse me. And we've been at this for a long time. And usually when I do presentations, it's very focused on strategy. And Julie's is more focused on the psych side of things. But today, what we're going to talk about is sort of a 30,000-foot view of the strategies, and then try to talk about the difference between how those strategies apply to different people, because we've definitely got trading strategies that are successful, that have been used by lots of people since we started trading and since we started teaching trading. And, really we work with couple groups twice a year of about 20 new people and 10 alumni usually. And I can tell you that, they all manage to put this stuff to work. It's just a matter of how they put it to work. That's different people, different psychologies, different ways of implementing the stuff. We've been at it for a long time. We started trading together in graduate school, and we were working on business degrees and psychology degrees. And, it resonated for us that there's lots of data that can be analyzed in stocks. Excuse me, just to clear my throat there. Lots and lots of data that can be analyzed in stocks, lots of ways to crunch the numbers, analyze what's going on. And, as I said, we're both PhDs. We publish quite a bit. There's lots and lots of stuff out there on our trading that you can find. So there's tons of publications and periodicals over the years where I'm either being interviewed about what we do or writing articles about what it is that we do. And it always boils down to the strategies that came out of the very first book that I wrote, which was Around the Horn, A Trader's Guide to Consistent Scoring in the Markets. That was a big multivariate analysis of covariance in the U.S. equities markets originally. And then we sort of switched things over and used the metaphor of baseball to frame things so that it'd be easy to remember the patterns and that kind of stuff. But everything was based on very sound statistical principles. Everything that we do is based on, math in the markets that works. And it's not that we dumbed it down or anything. It's just that we realized, pretty early in our careers that most of what we do is pattern recognition. And the fact that those patterns are based on some solid statistical stuff was important to us, important to the people we've worked with over the years, but you don't have to be thinking about the statistic every time that you look at this. The rest of these books are either worldwide publications or Tricks of the Trade and Trade Secrets of American publications of sort of different takes on core strategies. But in the end, everything really still revolves around sort of the 9 core strategies that we developed while we were in graduate school. We've added a few things, we've tinkered with things, but what works has worked for a long time. And what you should know is that as I talk about these strategies, every one of them is a very good fit for Julie and my psychology. And that's because we developed the things, right? So we developed these strategies around who we are. And a lot of times what we find is people get kind of frustrated with us because they'll say they want to come to one of the boot camps that we're doing, or they want to go and implement some of our trading, and we'll say there's some psychological inventories that you should fill out. We don't charge for those, we just ask that you complete them, and we'd like to talk to you about sort of your approach to things and your risk tolerance and your psychology, and make sure that it's a good fit, because we're very firm believers in you can't pound a square peg into a round hole. And a lot of people try to do that, and it's to their detriment. One of my favorite quotes is from around the turn of the last century. Bernard Baruch, you guys, if you know trading history, this is one very, very successful fellow. And he had lots to say about a lot of things, and his quotes are always very pertinent to the subject. And this one is really good, I thought. Get to know yourself, know your own failings, passions, and prejudices so you can separate them from what you see. And I think that really drives home sort of the core issue that we bring a bunch of stuff to the table. Whether we're working with our engineers, or we're working with our professionals from other fields, or we're working with guys who have, come at this from an entrepreneurial background, everybody sees the world through a set of lenses. And those lenses determine how you interpret what's right in front of you. And in order to get everybody to the same page, we need to get them to be aware of what it is, that prevents them from sort of conceptualizing this stuff the way that we do. And I think really the mix of, psychology, strategy, and discipline is the only way that you're going to get to a place where you're getting good results. This has to be really balanced. And, what I've found, I said earlier, a lot of times when I do these presentations, the organizers of big events, of small events, of any events will say to me, we really want you to come and talk to our folks about your strategies. The strategies are cool. They're fascinating. They're making money. It's so hard to find strategies making money. And I think that's generally at the expense of the discipline in psychology. At least it has been over time, which makes it really hard for people to focus on what it is that we're doing and focus on what it is that they should be doing, and getting to the point that they've got a good overlap in their trading, and just are doing this from a point of comfort and not from trying to force something because they see a strategy that might work for them. So as you look at this slide, around that table, this is 2 of the boot camps that we did in 2019. So there's always 2 a year. This year there may just be 1. Usually we'd be on the way to Miami Beach right now to get set for the spring boot camp. But as you look around that table, there are, I'm looking at the left slide, there's a guy who used to work for the TSA, there's a guy who's a property manager, there's an attorney, there's an entrepreneur, there's a guy who worked in biomedical research, there's a guy who's a tugboat captain in New York, and there's a guy who was a NASDAQ market maker. And we've got a guy who was a NYSE specialist. So, and in the picture to the right, there's an architect, there's a guy who was also an entrepreneur. It just goes around the table. These people all have very different ideas, very different lenses that they're looking at the world through. And what they share in common is a passion for doing this. They want to do this. What's different is they're coming at it for sort of different reasons. And, what we need to get to by the time that, the boot camp is over, which is, 4 days of really intensive training after about 20 days of really intensive online training that they did, is we need to get everybody to a place where the slate is sort of clean and they're looking at the market with the knowledge of, okay, this is who I am. This is where I'm coming at this from. This is my relationship with risk. This is my relationship with money. This is my relationship with pattern recognition. This is my relationship with boredom, with patience, with all sorts of things, right? And once they've got that backdrop in place, this becomes a thing that's maybe not easy to do, but it's a thing that's doable, versus a lot of other approaches to teaching people how to trade, which is just, okay, I'm going to show you what I do, and then you go do it. So I want to just tell you at the start here that, we're not selling anything. So our approach to working with us is we just let you look at everything that we're doing. And you have 30 days access. Those are the regular prices of what everything that you have 30-day access to would be. There's no credit card. There's no nothing. This is just you come, look over our shoulder. You can watch us trading live. As I said, we're a little light on the details on the strategies here today. It's a 1-hour session, so we're a little short on time, and we're trying to do the psych and the strategies in the same session. So if you just want to text open to that number, to 310-299-9148, then we'll just give you 30 days access to everything that we're doing. You can look over our shoulder while we're trading live, and we're trading live with our alumni. So there's 40, 50, 60 people usually in the room in the morning who have all been through the training. It's sort of an inner circle of traders. And I'll also send you a PDF about all the strategies, and I'll give you a link to a video, live video seminar, an on-camera thing that we did a couple of weeks ago that goes through and really details the 3 strategies that I'm going to talk about against the backdrop of psychology. So it'll give you a little bit deeper dive than we're going to do today, give you some reading. And again, none of it's a sales pitch. This is really based on, if you want to work with us, you'll tell us you want to work with us, and nobody's going to try to harangue you into doing anything. So with all that said, let's go and start thinking about the strategies. So what I'm going to do here, the way that I thought we would present this, is I'm going to talk about the strategies, and then I think Julie, since she does most of the interaction with the, here's where I'm having difficulty kind of questions that people have, Julie's going to talk to you about the psychology and the challenges of implementing each of these strategies. So the 3 that we're going to talk about today are the ones that have been, really knocking it out on the volatility backdrop that we currently have. These 3 strategies, the 2SD opening gap reversions, super cap volatility band trades, and the algorithmically based trades that we do, have really been thriving during this lockdown that we're having and during all this economic change that's going on. And I assume they're going to keep thriving just because of sort of the profile of these trades. We do a bunch of other stuff as well, but these trades, what they share in common is they can all be accomplished in the first hour of trading. So you're pretty much done with any kind of active trade management after the first 60 or 90 minutes. And where they differ is in a little bit of the risk and the frustration tolerance and the patience that's required to successfully do it. So let's start with the 2SD opening gap reversions. So a lot of people know this one because this is 20 years now I've been talking about statistical manipulations of the markets, and this has really been a core strategy that a lot of people know me for. Let's say a lot of people are very well aware of this strategy, but let's dive in a little bit and talk through this one. So the 2ST opening gap reversals, if you're an Around the Horn fan, that was called Baltimore Chop in that book because it's a pattern trade that looks like an old Baltimore Orioles baseball trick, let's say. This one, it goes through and it looks for S&P 500, S&P 400 stocks that are gapping 2 standard deviations beyond where their volatility indicates they should be trading. So back when we were doing the research on these trades, back when we put these models together, we were using the implied volatility of the front month contract to do this calculation. Now we use some other measures of volatility, true range, that kind of thing, as a proxy. And really what we're doing is we're scanning these every morning. We've got some software that brings them to us and shows us which ones meet the criteria. And once we have them, what we do is look for simple pattern-based entries that indicate that we are about to have a viable trade. So the scanner gives us S&P 500, 400 gaps in the market, and then we watch those gaps for either a 1, 2, 3 or a 1, 2, 3, 4 stair step, a flip top, a trap door, right? These are very basic patterns to get in front of, and they're really easy to understand. And what we do then is we teach people to target an important volume node or something that happened in the first bar of trading, or in the case of the trapdoors and the flip tops, a fib expansion as their target. So here's what these look like. These happen every day. Okay, and here is, this is the scanner that came up yesterday. And what it does is it goes and parses the data into longs and shorts, and then it shows you which ones are also news driven. So you'll see us using this in our trading room in the morning. This will all be on screen so that you can sort of follow along and see how this works. But you'll see also that there's 2 here that are highlighted in yellow from yesterday, UNP and MRNA. That just indicates those are the trades that I'll be taking, right? Those are the ones that I've filtered through for like this 1, 2, 3, 4 kind of a setup, the flip top at the trapdoor. And the reason that we favor this trade or this version of a gap reversion in the morning, of a mean reversion, is that it puts us in the 95% confidence interval of the mean. That's my psychology, right? I like knowing why I'm doing something, and I like know that there's a statistically sound reason to be doing something. This is the chart of UNP. This was a gap higher. You can't really tell that on this chart. I've blown the chart up a little so the bars are easier to see, but we're coming up from below. The gap is 2 standard deviations of the stock's expected movement in terms of here's the volatility, here's where we expect it to open, the range that we would expect it to open in. It's out 2 standard deviations from the mean, so we're expecting a mean reversion. And then we have a 1, 2, 3, and in this case 4 bar rise into the range. And the criteria here are very simple. So I'm just following this over the course of the morning. When number 2 there, bar number 2 forms, right? The entry of bar number 3 would violate, would be a short below the low of bar number 2. When 3 forms, it's a short below the bar labeled 3. And when 4 forms, right, then the next bar would be the entry bar, and we're getting short below the low of number 4, and we would target sort of a confluence area in bar number 1, the low of bar number 2, volume overlap, and that forms this picture right here. So this was an uncharacteristically tight stop, but our entry is right there at 158.17. Our stop loss would be 158.39 above the high of the entry bar. And our target in this case, 157.47. And that 157.47 target overlaps with sort of the open of bar number 1, that volume node over on the right side of the chart, that's volume by price. And, you know, I can tell you that what you'll see with some of the newer traders that we'll work with is that they'll take this trade as opposed to other opening gap trades because what they're focused on is that stop loss. Oh, it's got a really tight stop. And the reality is that has nothing to do with whether or not it's going to be a good trade. What determines that it's going to be a good trade is the way that the trade has set up in the morning. And, getting people to look at these things not in terms of dollars is, generally speaking, very difficult, because really what they're focused on is how much am I going to make? How much do I stand to lose? And that stand to lose part of it is usually wrapped up in a whole lot of, here's my pain threshold. And your pain threshold really doesn't matter because the market does not care how much you're willing to lose, right? The stop has to be based on something objective. And what we found over time is if you use a support and resistance based stop, if you use a natural order flow stop, then you have a really much better chance of a successful trade than if you just have an arbitrary stop that's likely to get hit. So the psychology of this one is all about patience, structure, and conviction. And Julie is going to give you her 2 cents about what it is that makes somebody successful with this trade versus what it is that puts somebody in a difficult position.
Okay, so of the 3 trades Adrian's going to talk about today, the idea is I'm going to give you a profile of who wants to do that. So as we go through this, I want you to think about your own trading strategies. Maybe you don't trade intraday, but any strategy that you approach, you're bringing yourself to it. So I think that the next comment is important. Men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn, but it's only after a stock operator has firmly grasped this that he can make big money. Adrian always tells people too that there's really nothing new in trading. And this is from the 1920s, right? Jesse Livermore. Most traders today who are doing this for a living will tell you the same thing, that the things they've learned is that patience is one of the most important things they do. All trades involve some degree of patience, and that's on a continuum. This trade, so we're going to look at all 3 trades in terms of risk, which inherently has money in it, and skill, which is not something that people talk about a lot. It's super important in intraday trading because how well you can handle an order has a lot to do with which kind of trade works best for you. And then, of course, it's range patience, how much patience you need to have right now in general to, again, you look at this quote, to make money in the end or to profit or be successful, let's say, in the end, you're going to have some patience. But it's a range. So these require a different amount because there's a different structure. Of the 3 trades, this one is somewhere in the middle. It's a trade that is going to come. If it comes to you, what you're going to do. There's only 4 entries and 3 exits. So there's a structure to it. And it requires some skill, medium amount of skill. All intraday trading requires a good degree of order handling skill. But this one requires you to enter, sit tight, like this quote says, and then exit again. A little bit of that can be planned. You have some time to set that up for an automated entry and some time to set that up for a exit. So this one is one of the ones that a lot of guys folks who gravitate towards this have good, solid skills. They understand trading, and this is something that makes sense for them in terms of what they're willing to risk. They can control their risk by the number of shares, and it fits the psychology of someone who doesn't want to sit there all day and can make fairly large, these things trade in a fairly large range. So all of our trades are traps. This is sort of as an overarching idea is there's hunters and there's trappers, and we are trapping trades. We're always laying in wait, like a cheetah in the bush, but we're not taking every antelope that runs by. We are going to grab the ones that that are the very best to grab. So that's the 2SD gap. It's a trade that people who have a good understanding of intraday trading, but also like to get on with things.
Yep. So think about this against the backdrop of who you are, because what tends to be the case is a lot of people are attracted to that trade because on average, it'll pull a couple dollars a day per share traded out of the market. So, if you're trading 100 shares, you could be pulling $200 a day out of the market with that trade. But the key there really resides in what Julie was just saying. It's a trade where you might have to filter through 5 or 6 opportunities in the morning and then patiently lay in wait, right? We are not chasing stocks. We're not chasing momentum. What we're doing there is we've set a trap. We're waiting for the stock to come to us. If it comes in, great. If not, well, then it just didn't come in, right? And maybe we picked the wrong ones, or maybe we have to endure a day where none of them trigger, but one way or another, right? What we had is what we had. I tell my people always, trade, it's what is, not what's, what you want it to be. So now let's move on and say, here's a trade for a different kind of trader. And, what you're going to see when you look in over our shoulder in the trading room is Julie and I are trading all of these things, but a lot of our guys are focused on one or the other. And that's because these things resonate with them based on what the trades are, as opposed to them having integrated them completely into their psychology. This is one that is actually a little bit more complicated, more skills-based. This, as a matter of fact, I just completed a course for our guys. This is about 16 hours worth of training that they go through before, they really feel comfortable with these notions. But it's really a pretty simple trade when I do this at the Traders Expos and the money shows and things all the time, because it is a simple trade at its core. What you're doing is identifying trading candidates with high price, range, and volume. So these are going to be the NASDAQ super caps usually. There's a couple of NYSEs. We trade BABA, we trade Boeing sometimes, but in essence, this one really hinges pretty tightly on Apple, BABA, Netflix, Nvidia, Tesla, right? Those kind of stocks. And what we're doing is we parse today's trading activity into visually identifiable ranges or bands of volatility. I call them volatility bands. And you're taking today's trading activity and projecting it forward to tomorrow and saying, if the stock opens in line, if the stock opens within today's volatility bands, then where do I expect the inflections to be? So essentially, when I've worked on hedge fund projects, a lot of what I was doing was programming up algorithms that would punch in and out of these stocks at specific levels. And based on that history and based on that idea, then we're trying to predict in our own trading, well, where would the programs be hitting these stocks? We watch the pre-market for inflections at those bands. If there's going to be a gap, we watch for inflections at prior sessions bands. The bands are sort of always on screen. They ride from one week to the next unless they've been violated. In case, we in that case, we go and recalibrate the bands sort of. But really, we're just looking at the big picture trend, and we're saying, as inflections occur at these bands against the backdrop of here's the big picture of what the stock is doing, we're going to go and take those inflections and we're going to trade them. Is a very different trade than that last one that we looked at. So look at this chart. So here's Apple yesterday. Yesterday was a typical day in this one. We typically get good success around the open, around the first half hour or so of trading with this one. And here you see that blue line, 312.15, that was the first inflection. The first stop was right below that at 311.45. And that was based on a violation of those lows right there in the circle. And so your very first trade of the day is a stop out. Then we get a move down into the range, and the next inflection point is 311.15. So we've identified the places that we're going to go long the stock. And this is just a matter of you got to get in there and do it. So you've got these lines drawn. The first one just handed you a loss. Granted, again, this is not a major loss, right? But a loss is a loss. And to a lot of people, life is about some sort of a sports analogy where losses are bad and wins are good. And it makes it difficult sometimes to take the next trade. Very important that you took the next trade. because that one was a $1 per share move from 311.15 up to 312.15. Then you had a reversion back down again. 311.15 would have triggered you in, triggered you right back out again at those at the lows of the prior bar. Then 310.57 would have triggered you in, and that one gave you a move up and through 311.15 and then all the way up to 312.15. But you can see, looking at this now, picture yourself working with this trade and ask yourself, against the backdrop of my first trade very quickly went to a loss. Then I had my second trade, and that gave me a profit. Did I take the second trade after I lost money on the first one? What's my psychology look like? How do I feel after I took a loss on the first trade out of the gate? Because I tell all my guys, get that P&L off the screen. P&L should not ever be on your screen. Why? Because that's my psychology, and that's how I set up my trading when I set up these patterns that work for me. And the best thing that I can tell you to do in your trading, if you want to replicate what I'm doing in mine, is to try to sort of set your head up the same way as mine's set up. If I've got my P&L on the screen, I know ahead of time that there's going to be damage done by me seeing that negative number right out of the gate. So I don't want to see the number. What I want to focus on is, where's the opportunity? The opportunity is at each one of those bands. And my job as a trader is to get in there and focus on, in this case, very skills-based execution. Right? I have to be very confident in the fact that I can navigate in and out of the market quickly, and that these decisions that I have to make on the fly are decisions that I can react to in time, because there is a lot of damage that you can do to yourself by saying, all right, I'm long. Well, now it's going against me. It's going to hit my stop. Well, wait a minute. I might see a better stop over here. Maybe I'm just going to let this one go a little bit further. And then, well, you know what? I'm really getting much further down in the range here. And as a matter of fact, maybe I want to be a buyer down lower than I am here. And as you start unbinding your logic for things, what tends to happen is you do damage to yourself that you don't even know that you're doing. And God forbid you're rewarded for one of those decisions. Because when you're rewarded for doing the thing that violates your discipline, you get into something in psychology called the recency effect. And now you're going to be more and more likely, because of recency and intermittent reinforcement, which is the most powerful reinforcement. Right? Intermittent reinforcement is that thing you remember from college where, the rat's in the box, and if he pushes the bar and he gets a pellet, and then he gets a pellet every single time he pushes the bar, then he'll stop pushing the bar as soon as he doesn't get a pellet. But if he only gets a pellet every nth time, or every random nth time that he pushes that bar, he will push the bar forever until he dies, even if he never gets another pellet again. And it's very, Rat Lab is done for a reason. It's very similar to what happens with human beings. If you make a decision based on something outside your logic, based on something outside your discipline, and that decision rewards you, you've just put yourself in a position of having to undo a whole bunch of psychological damage before you're going to trade right again. So that being said, right, just take a look at that range right there and ask yourself, that was 4 different trading opportunities. They happen against the backdrop of a fast market. How comfortable would I have been trading this one? Because what you have to do to trade this kind of a setup, I think, is find order in chaos. That's got to be part of your psychology. You have to really exhibit grace under pressure. And by that, I mean you're just sticking to your discipline, and you have to have some flexible thinking.
So if we think about those 4 different areas we talked about earlier, risk, skill, patience, and structure, this one is the most extreme in all of those. So you have to be, your skills have to be top notch to get these trades, turn around these trades. You have to be have a very good relationship with money. You really have to know yourself for all these trades. And what you have to know about yourself for this one is you're going to be okay. And you only really get that through a really high degree of patience and flexibility. And sometimes it's just time on the job. So you need to know your strategy, which is super important. The way you develop patience is knowing that one of the ways you do it is knowing what your strategy is and how often it's right. We do a whole lot of simulation where we are. A lot of people like to do back testing. I realize that if you're swing trading, that's one of the only ways you can do it. It takes a long time. In real time, we have a simulator we like to use that will do intraday trades, but you can also do them over, day over day. And it's very helpful to have a strategy and then go back and forward test it. See, what would I do? Because not only does it show you what your strategy does, it's a really good way of gauging your gut and knowing, how do I make decisions on the fly? So this particular strategy is fairly advanced. Now, it doesn't mean you can't do it if you're not advanced. There's a whole lot of learning, and we talk at Trader Insight a lot about a growth mindset and a flexible mindset. And if you know that you can, there's a whole lot of research and neuroscience research that if you do things again and again, if you learn, there's areas of your brain that actually grow. The neurons actually reconnect. So you can always learn to do a new thing. What we're trying to say here today is look at your strategy now and see how well does it fit you today. So this strategy is a good one for someone who has really good skills or wants to develop really good skills and is really good at grace under pressure. I think that was a really good way of saying that.
Okay, so that being said, again, picture yourself in each one of these scenarios. This is a very important thing, this visualizing what what you would do or what your react. These are intraday trades, right? We're day trading. We don't hold positions overnight. And, we've got very consistent traders. We have very consistent things going on. It's all about, they see themselves doing this. This is not, again, this concept of pounding the square peg into the round hole, but it does come to play that different strategies, even within our strategies, work for different people. Now, this next one, picture yourself again against the backdrop that I'm going to give you. Bernard Baruch, once again. Last one was Jesse Livermore. This one's Bernard Baruch again. I never lost money by turning a profit. This trade, the sort of psychological thing that goes on for people is they're a little bit uncomfortable usually with the notion of where the profit objective is on this one. And people always want to see, can they maximize the profit? Can they trail the profit? And over time, right, what we proved with this strategy, this particular strategy on average puts up about $10 per month per share traded. So it's a very high reward kind of a strategy if you implement it by the rules. This is a range expansion strategy. This one goes and finds stocks that have made significant expansions of range and volume for today. And this is a cornerstone trade for us. This is a core trading strategy. What we're going to do is, in this case, this again came from work that I did on a hedge fund. This goes through and identifies the source of the expansion. So in other words, was there a persistent buyer or seller all day? How many times did that buyer or seller come in and push the market away from the volume weighted average price? How many times when there was an excursion of X% from the volume weighted average price did that market participant push the stock back to the VWAP? How many times did an anchored VWAP come into play over the course of the session? And when price got back to that level, how many times did that previous buyer or seller re-exert the pressure on the market? So we know a bunch of things about how institutions trade, in other words. And once we see those things playing out on an intraday chart, can we then identify whether or not the person who was responsible, let's say, for doing that trading, did that person come in and reassert pressure on the market? And if he did, can we predict what's going to happen tomorrow? And then what we're really doing is we try through the model to recreate the algorithm driving price. And then the model just spits out, here are the stocks that we're going to be interested in looking at for the next day. We plan to enter in the direction of the expansion, in the direction of the movement for the stock. And then here's the trick for a lot of people. It's going to have a pretty wide stop loss initially. Usually the ratio on this one right out of the gate is upside down. You're not beyond one, you might be less than 1-to-1 on the reward to risk. That changes very quickly because the first goal here is to find a suitable place to move your stop intraday. But wrapping your head around sort of trading differently, there's another very good quote I could have used about percentage winners that Bernhard Baruch again had, that you can have a trading strategy that's only right 20% of the time. And if it's right by enough, it makes all the difference in the world. Well, this one is right 80% of the time. So the fact that the triggers that I get into are going to consistently get me to a profit objective is what I'm relying on in my psychology to follow this trade. It doesn't trigger constantly. Like I said, you might have 30 opportunities over the course of the month or 50 opportunities over the course of the month, but only 10 or 11 or a dozen trigger. The profit objective is going to be either the first floor trade or pivot line in the direction of your entry or $1 per share, whichever one comes first. Statistically, we've proven time and again that's a real good model for how to get yourself in front of the maximum profitability for this one. The place that it's difficult for people is the guys who like to tinker with trades don't like this one as much, right? They prefer to get in there and trade those volatility band setups. They prefer to trade those opening gap setups. This one's much more of a set it and forget it thing. This falls much more into Julie's wheelhouse as far as trading it than it does into mine, for example. So for years, what she's handled are what we call the around the horn core trades. She's handled these trades. The defining factor with these is it's not a skills-based trade at the order entry level. A lot of what we do is based on you need to know how to work the book. A lot of what I do, right? I know how to work an order book. I know how to work order flow. I'm very competent with Realtek, which is the software that we use, right? That's institutional trading software. It's geared for people who are looking to navigate the market very, very quickly. And not surprisingly, right, Julie's forte is really sort of thinking through the trades. Right? We're different people. We have a different competence. We have a different thing that makes us good traders. Julie's very good at taking these trades, setting them up the night before, right, through a series of conditional orders, and then just putting those orders out there and letting the market take care of it, letting the order flow come to her, having these things execute automatically. You can see here on Domo, this one was from yesterday's list of trades. There were two on the list. It was DOMO and RARE. You can look at them if you like. You'll see these again every day during your 30-day open house, right? You'll see every single day how these play out and what the opportunities are. But look here, this one, the entry threshold was $22.40. There was too much slippage on that first bar of the trading day. If you're a very active trader and your psychology is all about you have to have your fingers on the keyboard, you have to have, everything is about the excitement, the adrenaline, which is not necessarily a good thing, I'm going to tell you, but let's say that's where you're coming at it from. This kind of thing can be frustrating. So, it hits a target right out of the gate and I wasn't in it. Oh God, right. I didn't look at this again, it missed me. Well, the important thing to Julie is it was outside of my maximum slippage. So I didn't get into that trade. And then when it came down to this level again, she's not thinking about, am I catching a falling knife? She's not worried about, oh God, now here it comes from the wrong direction, right? What she's worried about is, okay, I've got an order out there that says if last price is less than $22.35 per share, then buy DOMO, 2240 stop, 2250 limit. She knows exactly what her entry price is going to be. She knows exactly what her maximum slip is going to be. She knows that it's coming from underneath. It's gone down, it's based for a second, it's coming back through the price. and she knows she's going to exit at $23.11. What she doesn't care about is the fact that it went to $23.90 the first go around, right? That doesn't bother her. That's not coming into the consciousness. She doesn't care if it's going to wind up going to $27 on the day, because this is a disciplined trade. This entire setup is based on your approach to the market is like clockwork, right? This is your psychology here. Now, for me, the reason this trade exists is I needed a bunch of diversification in my trading strategies, and I wanted things that I could put out there and just have them trade the way that I would trade the market and do it on their own. So Julie, what's attractive about this is as long as she goes and trades this thing very methodically, puts the orders together properly, puts them out there the night before, that's the clockwork part of it. She just has to be methodical about it. She knows over time, here's how this thing performs. That gives her the confidence to do it. And then she also knows, well, a lot of days it's not going to trigger, but I know what the consistency looks like. So I've got the confidence. And I know that if I'm persistent in putting the orders out there and making sure that everything's structured correctly, then I don't have to have my fingers on the keyboard every second of the morning and be trying to figure out how to route the order out and figure out, should I be going out through NAS? Should I be going out through ARCA? Should I be routing it, through an alternative display facility? What should I be doing to get out of this thing at the price that I want to get out of? The entire competency here is understanding the setup and then understanding how to pre-program the order so that it takes care of itself. That's a very different psychology than the last two things that we looked at. And it just requires a little bit of a different mindset and a willingness to grow and think about things differently.
So of these three trades, and if we go back to risk, skill, patient, structure, this one is lower on your risk and your skill, but it is hugely more important to be patient in this one. So if you know yourself and you know that you're able to sit on your hands and not have to be trading at every moment, then this might be a great trade for you. It's very uncomfortable for the people that need to tinker. And it comes into this idea when we're talking about trades and talking about it in our trading room. We have a trading room every morning, and a lot of times some of our more advanced, or rather, more experienced traders will talk about their experiences. We talk sometimes about delayed versus instant gratification. This one is going to be a little bit more of delayed gratification. We live in a world now it's all about instant. You can get to the ATM and have your money. You can order food and have it right away. You can, you send a text and you're thinking they didn't answer me in 10 seconds, that we want it right now. This is the one where you go back to your training and whatever profession it is you do, and you realize I didn't learn to do it overnight. And though maybe it only is a half hour, when you are if you're someone who wants to be trading intraday and trading constantly, that can be hard to do. On the flip side, it's really great for our traders who like to set it, watch it, but forget it. And they have naturally a lot of patience. So in our trading strategies, we have a variety of things that cover all those areas. I don't think Adrian would say it's wrong to say I am more patient with the trades. So I will monitor our core trade that has results that go back 20 years. I'm the one that monitors that over the course of the day. That's more of an intraday swing. Sometimes they're all done within an hour. Sometimes a few of them aren't done till end of day, and it requires that kind of patience. So anyway, we have a bunch of different things that stretch our psychology, but fit our psychology.
So I think that in dealing with, we've trained a couple thousand people over the years to make their living in the markets. And the takeaway from me has definitely been getting to know these people personally has been huge for us. It's like, it's not just a case study. It's that they all become very good friends, right? Because again, the person who gravitates to learning with us is usually somebody who's got a psychology that's pretty similar to ours, and we enjoy those people. We just enjoy being around those people. And, as I said earlier, though, what you come to realize is people look at trading from a bunch of vantage points, and I think the reason for the high rate of washout, the reason for people blowing out accounts, for people not ever being able to persevere so many times, is that their psychology doesn't really align with what they're doing. So they'll get into futures, or they'll get into options, or they'll get into stocks or forex, or whatever, and it's not based on, hey, this is something I understand and makes a bunch of sense against the backdrop of who I am. They're getting into it because they like the leverage, because they like the potential return, because they got some email that said they could make 1,000% return. I get an email that says somebody made 1,000% return, and my first reaction is, no, you didn't. I know you didn't make 1,000% return. Other people get that, and they see the same email and they say, whoa, what if this guy really made 1,000% return? What if I can do this tomorrow? I think it's about understanding who you are at the outset more than it is about cherry picking something based on you think you can make money with it. So that's our 2 cents on the psychology of trading. That's our 2 cents as psychologists on, where you need to approach this from. It needs to be, this makes sense to me. I get this. This is comfortable for me. And, really, I think if you do that, then what you'll find is, because I meet a lot of people who will tell me they've been trading for 20 years and they have never really made a living doing it. And my question for them is always the same, right? Does what you're doing make sense for who you are? Because I'm sure we can find something that is going to be right up your alley and going to make total sense against that backdrop. So again, you guys, it's not, there's no special, there's nothing for sale, there's no credit card or anything here. You can get complete access to watch us do this and watch. There's 40 people who trade with us at least every day. Those are all guys who've been through the training, who have adopted this and are trading it for a living. You can watch us all doing this. You can participate. You can talk to us in the morning. Just send the text OPEN, OPEN, to 310-299-9148. And it'll start first thing tomorrow morning. We won't make you wait till Monday. You'll also get a link to a recent video conference that I did, where I go through and I actually detail the mechanics of each one of these strategies. I go take a much deeper dive on, sorry about that. I take a much deeper dive into what these strategies are, how they work, and show you exactly what it is that's required to deploy them and make them work perfectly. And then you'll also get a PDF that details the trading strategies, gives you sort of a written version. It's sort of a book, about 40 pages long. Again, it's no advertisement. It is just details on the strategies, and you get all that stuff after you send the text. So pop us a text. Let me know if you have questions here. That's probably the first time that phone has ever rung in the last 20 years. We'll be happy to see you. We'll be happy to work with you. So does anybody have any questions before we finish? No, we've got about a minute left. Okay, I see John there. So I put the number back on the screen from earlier. I see David put it up as well. Thank you. And if you guys have questions, the other thing you can do is shoot me an email, Adrian, Adrian, at TraderInsight.com. I'll be happy to answer.
Come join us.
Come join us. Come have a look at what it is that we do, and you can see if it's a good psychological fit for you. All right, folks. Thanks for coming this morning.